Well, thanks, David, for giving up your time for this. David is Director of Share Schemes, I think it is, at Haysmac, and is the font of all knowledge and experience in these matters. These are the kind of things I've used on a number of occasions in other businesses, and they're incredibly effective if you get them right. There's plenty of ways to not get it right. You know, it's something that's worth spending the time up front trying to get right, not just for yourself and the business, but also for the people at the end of the day you're trying to enhance and motivate through options. So anyway, thanks, David, for putting this together, and look forward to hearing what you've got to say.
Thank you, Andy. Thank you. Yeah, so the presentation is going to be today about EMI, which probably you've heard of as being a particularly flexible and tax efficient share scheme. So share schemes come in all forms, shapes and sizes. There's certainly more to it than just EMI. But with EMI, the tax benefits and the appeal of it are so good that it tends to be the one that we see the most. So I'm not going to spend too much time on explaining the basics of what is an EMI scheme. I'm hoping most of you are reasonably familiar with that. A share option scheme that qualifies for certain tax advantages. But what I will go through is talk about some of why it's important to get it right, and some of the areas that in practice we see clients sometimes get wrong, and what you need to look out for to make sure that you get an effective EMI scheme, and say not one that trips up because of a technicality. So nobody likes being in that situation. Obviously, I'll take questions at the end. I don't expect I'll be speaking for much more than 15 or so minutes. So if you can add your questions via the chat, and we'll go through them at the end. So we're going to talk through EMI pitfalls. So very first, so why is EMI so appealing in the first place? Why do companies do this? As I say, it's a flexible employee option scheme. So employees get the option to buy shares in their employer company or the top company of their employer group. It's relatively straightforward to implement. No upfront cost for the participant, so no real tax buying cost or anything like that at the very start. And these are usually aimed at exit-based schemes, but you can see them in all shapes of sizes. So typically you'd see people exercise immediately before an exit, so that they participate in that. But there's no reason it has to be. Sometimes you see employees just are able to acquire the shares after a few years, after a vesting period's been complete, and actually become shareholders. So that's talking about the flexibility of the EMI and how you can suit it for your business needs. So no upfront cost for the employee, tax rate of usually 10 or 20% if you get it right. Usually no national insurance for the company. So in that sense, it's both the employee and the company making savings. The employee getting within that 10 to 20% tax bracket rather than potentially 40% or even 45%. Saving an employer's NICs, corporation tax deduction on exercise for the employer, which can potentially be very valuable, and also certainty on valuations. If people have done these schemes before, you'll be aware one of the big advantages is you can agree a share valuation up front with HMRC, which gives a lot of certainty to what you're entering into. You don't have to second guess what the valuation might be on date of grant, because you can get it all agreed up front. So that's why it's so appealing and why so many companies look to do it. But of course, when you've got such attractive tax benefits, obviously if you get it wrong and inadvertently don't get those tax benefits, it's quite a big difference. So we look at, well, what's the cost of getting it wrong? you've got an increased tax rates for employees and employers. So you go from that 10 to 20% capital gains tax bracket into 40, maybe even 45% income tax plus national insurance. So it's costly for the employee and the employer. These things are often discovered during DD processes. So if you do get an EMI scheme wrong, maybe you get the documentation or something wrong, then it's typically, you wouldn't notice it right away, but it's the sort of thing that always gets brought up on a sale process, on either a tax DD or a legal DD. It's very common that when you see DDs, what the major issue, that if you normally have a major issue, it's normally on a share scheme or an EMI scheme of some sort. So it can be very stressful to try and unravel errors during a sale process. And that, of course, can affect the deal process. You have to then start drafting indemnities and warranties, etc., into SPAs, and it's no fun at all. If the errors are discovered after exercise, it can get even worse. If you should have operated payroll taxes because the EMI scheme was faulty and you didn't, that can result in all sorts of penal tax charges for management in the company. And of course, you're generally aiming these schemes at your key employees, and they're obviously not going to be particularly happy if they thought they were getting a tax efficient EMI scheme that then proves to not be a tax efficient EMI scheme. See, they budgeted for paying 10% or 20% income tax, and you're now turning around and saying, because of a company error, they have to pay the higher income tax rates. So that obviously goes down like a lead balloon if it does go wrong. So that's why it's so important to get these things right. Here's a summary of certain things that can go wrong. Company didn't qualify in the first place, drafting errors, disqualifying events, reporting errors, or exceeding EMI limits. We're not going to go through all of those today. We're going to focus mostly on if the company didn't qualify for EMI in the first place. There are a couple of tricky issues that can easily apply. We'll do a little bit on reporting error as well, but that's a little bit simpler. So company didn't qualify for EMI. So there are certain qualifying conditions for EMI. The government doesn't let every company do it. The first couple of tests are 250 employees and 30 million gross assets, are generally there to just ensure that this is aimed at the small and medium sized companies, not your bigger players. But the next two bullet points are a little bit more niche, a little bit more technical, but I've seen them bite on a few occasions. So the third one talks about if your EMI company, if it controls another company, but it doesn't have a majority shareholding, then that prevents it from doing EMI. And we'll go through that in a little bit more detail later. But it can apply in a lot of situations where you're expanding into overseas territories. I'll do a specific slide on that later. And then the next one is, you can't have EMI if your EMI company is under control of another company. So if you're a subsidiary company, for example, then you can't do EMI. You would have to do EMI in the top company. And usually that's very clear. You've got a clear group structure. You can identify the top company and do EMI there. But sometimes when you've got different types of corporate structures, for example, you've got companies with partnerships or LLPs or limited partnerships sat above it, it can get a little bit more complicated to confirm that you're not under control of another company. So we're going to go through an example where that kicks in as well. Okay. So here we have in this slide what it describes as the local partner problem. So this is getting at the point that if you have a company that you control, then you have to own a majority shareholding in it in order to be EMI qualifying. What you can't have are companies beneath you that you control, but you only own 40% of the shareholding, for example, that trips up the EMI legislation. And you think, well, that must be pretty rare. I mean, usually if you control a company, it's because you own the majority of the shares. That would seem fairly obvious. In the majority of cases, yes. But the area where this often bites is in joint ventures, where sometimes you might own 50% of the company and maybe you have controlling rights because of shareholder agreements or something of that nature, but you don't actually own the majority of the shares. You might only own half. So that can apply to all sorts of joint ventures. But very specifically, this can apply when you're expanding into overseas territories. So for example, in China and in a lot of Middle Eastern countries, if you want to set up there, they don't just let you set up 100% subsidiary over there and then trade through that. They might have specific rules that say, no, your subsidiary, your Chinese or your Middle Eastern subsidiary, that has to be majority owned by a local partner. So in this scenario, the local partner would own 51% of the shares and our company would own 49%. So that would be a company where we don't own the majority of the shareholding, but economically, the way around the local partner having 51% is we say, hey, local partner, here's 51% of the shares, but we have some sort of shareholder agreement or contract that says, whilst you have 51% of the shares, because that's required under local law, we have an agreement that says that you have to pay us the majority of the profits, the majority of the dividends, etc. So the economic benefits flow back to our company because it's basically our company. But the local partner technically has to own the majority of the shareholding just to get around the local regulations. And from an EMI perspective, this is actually a problem because you've got this overseas subsidiary that you control. You control it because you've got an agreement in place that says you get the majority of the income from it. But technically, you don't own the majority of the share capital. And so that would actually mean that you don't qualify for EMI if you have this type of structure. Now, if you qualify for EMI to start with, and then you put in one of these structures, that's not necessarily a problem. It doesn't taint the options you've already granted, but it does block you from doing options going forward. So it's a very important point that if you are looking at doing some sort of overseas expansion into these types of territories, say China and Middle East are the typical ones, but it can bite elsewhere. If you're looking at doing EMI options as well, it's definitely best to do them before you set up this structure. So in other words, get your options in before you do this structure. And the second type of structure that causes some problems is what we call the LP problem. So you can't have your EMI company under control of another company. Usually that's clear, but here's a scenario that you sometimes see in PE type scenarios. So your company might be majority owned by a limited partnership, for example. Quite often you see PE investors invest via limited partnerships. And you might sometimes see, well, actually that limited partnership is majority owned by natural persons. In this case, we said 99.9% is owned by individuals, and the general partner, which is a corporate entity, only owns a very small percentage. So you would think that EMI company is not under control of another company. Unfortunately, the test that applies is that you're caught if you're under control of a company, i.e. the general partner, and persons connected with that company. And the nasty rule is that general partner is connected with all these other individuals in the partnership. Effectively, your partners in the same partnership, you're connected for tax purposes. And so actually the general partner for EMI purposes effectively controls the EMI company by way of its 51% shareholding via the limited partnership. So if you do have this type of scenario, you need to be very careful about doing EMI. I've seen companies with this type of setup, this type of structure, and they've tried to do EMI, and we've had to tell them no, it just doesn't qualify, and they've ended up scrapping their EMI and doing something that actually works, like a CSOP. So if you do see that type of scenario where you've got a limited partnership or other type of partnership arrangement that owns a lot of shares in the company, then that can be a problem for EMI and needs to be looked at. So those are two scenarios that that are seen a few times in practice that can scupper EMI, where potentially you wouldn't have thought that they would be a problem intuitively, but because of the way the rules are drafted, they are an issue. And so just on a final point, one of the other areas where companies sometimes get things wrong, this is a little bit more routine, but just as important, reporting errors. I've seen a lot of companies get in trouble with this. So the reporting requirement is actually relatively simple. You just have to inform HMRC, you have to notify them within 92 days that you've granted EMI options. That's done via an online portal. A lot of companies do this themselves. A lot of companies get an agent like haysmacintyre to do it for them. It's a relatively straightforward process, but it's one that's sometimes missed, because you grant your EMI options and maybe you just don't realize you have a reporting requirement, or you don't tell your tax advisor that you've done this, and therefore it slips through the cracks. So the process is you just have to register the fact that you have an EMI scheme, and then notify those options to HMRC by uploading a spreadsheet to them, setting out the details of the options. And occasionally that's missed, and the bad news is if you do miss that deadline, then effectively the options are not EMI options. That's a very small admin point that can potentially cause a lot of problems. You can potentially apply for reasonable excuse. You know, if you're late because you have a reasonable excuse, HMRC might accept that. I've got a few of those through in my time, but they do set the bar quite high. If your excuse is we didn't realize we had to do this, or we forgot to do this, that's probably not enough. So if you do go through getting an EMI scheme done, I would say once you've done the documentation, try and sort out this reporting as soon as you can, because it's a simple exercise, but one that you need to make sure that you get right. Okay, so I think that's enough of me for now. We've gone through a couple of scenarios, a couple of structures where EMI might be a problem, and the reporting requirements. So that's not an exhaustive list on what can go wrong with EMI, but they're some of the more common things that I see. So with that in mind, if anybody has any questions, I'd be delighted to take them.
I have a question, David. Thank you very much for that. The local partner problem, you mentioned putting in place the scheme before you set up the local partner entity.
Yes.
What does that mean in practice? Does that mean you have to do all of the grants and get all of the grants done before you set it up? Or is it just set up the scheme and you can, as long as the scheme's established, you can grant after you've formed a local partner?
Good question, Jeremy. Thank you. So when I say it needs to be set up before setting up the local partner, then I mean it actually the options need to have been granted.
Okay. And so no grants are allowed after the setup of the local partner to qualify for the scheme?
Correct. Well, whilst you have that structure in place, it will block you from doing any further EMI options.
Okay, great, thanks.
So I've got a couple of maybe just points of clarification. David, you talked about the potential tax rate for employees, 10-20% or whatever, and it might be really obvious, but when does that become liable? In the year that the shares are liquidated and they get their return on that in that tax year, or is it there's no relation to when the options are actually granted, I assume?
Yeah, so the 10-20% rate, that's on the basis that you exercise your EMI option, and if it's been done correctly, you've set the value at market value, you've not tripped up on any of the EMI techie points that I've suggested, you should have no income tax on exercise, and then you pay your 10 or 20% capital gains tax when you sell your shares.
Okay.
So in practice, if you have an exit only scheme, you'll exercise your option and then sell your shares immediately. So it will all happen. It will all happen at the same time. Whereas if you do fall foul of these and you have an income tax charge, that will be on exercise of the option.
Right. Okay. Because you did mention income tax, and I just wondered where that came in as opposed to capital gains tax. Oh, hi,
Yes.
Ken. Hey, Keith.
Okay.
And Daniel. So
Yeah. Yes, if you do have an income tax charge, it will occur on the exercise of the option.
Yeah.
Now, if that's an exit event, then you've got the bad news of the income tax, but at least you're in a position where you can actually fund that liability. You know, at least you'll have some cash proceeds in which to settle those liabilities. The problems we sometimes see is people exercise when there isn't an exit on the table, and they've inadvertently crystallized an income tax charge, like a dry income tax charge, because they don't have the monies available to pay the income tax.
Okay. And then one of the things, and you didn't say you were going to do sort of an exhaustive thing, but in your pie chart, you had disqualifying events, which I thought sounded intriguing. Things that can go wrong, I think it was. Can you say anything about disqualifying events?
Yeah, so these are, if you've granted your options, then you qualified, you met all the conditions to start with, then normally you would get your tax relief, obviously on exercise, but you're not completely home and dry. You can have what's called a disqualifying event, which are post-grant events that take away some of the tax advantages that you've accrued. They don't necessarily take away all of the tax advantages. You get some sort of hybrid arrangement where you bank your tax relief to date to that event, but you then get income tax on the growth in value afterwards. And these disqualifying events can be wide ranging. So they can be, for example, you come under control of another company. So for example, that VC investment where you had the limited partnership, that would not only stop you from doing new EMI options, it would also be a disqualifying event for your existing ones. Whereas something like the expanding into a new territory and having that non-qualifying subsidiary, that local partner, that whilst that blocks you doing new EMI options, it would not disqualify your existing options. So in that sense, it's a little bit more benign. Other disqualifying events can be an employee ceasing being a full-time employee.
Okay.
So if they leave, that's a disqualifying event for them personally. A company ceasing to have a qualifying trade. So you see, for a lot of tax purposes, if you have too many investments or too many non-qualifying trading activities, that can cause a range of tax issues, and one of them can be disqualification of EMI. Again, that's not an exhaustive list, but those are the most common ones that we see.
Okay, so in amongst that criteria for being able to qualify, I think there was it a number of staff and a turnover limit.
Yep.
If you cross those during the sort of the period that those options were in play, does that become a disqualifying event, or is it not, because they were done at the right time and under the right circumstances?
Good question, Andy. So that's not a disqualifying event. So I mentioned a couple of size limits, so 250 employees and 30 million gross assets.
Yep.
You have to meet those. You have to be below those at the time you grant the options. But if you subsequently go over them, it doesn't disqualify your existing options.
That would be so counterintuitive, because the whole idea is to help growth.
Exactly.
It was actually a silly question, not a good question.
It would be a perverse incentive to not grow.
What was I thinking? Just a bit more coffee and I'll be fine.
No, but we've had clients very, very recently, like in the last couple of months or so, get very, very anxious about potential disqualifying event because they'd gone over 30 million gross assets.
Right. Okay.
And it was literally it was almost like an early Christmas present when we told them, no, this isn't a problem.
Great.
Because there's a lot of misinformation about what prevents you doing new options versus what's a disqualifying event for your old options, and they don't necessarily marry up.
So I was wondering whether any of your contacts in HMRC in setting this up would have a word with their Irish counterparts and the revenue commissioners here and set something up that's quite so tax efficient, because it's a little more punitive in the environment over here. Although there's a lot of similarities in the way options are set up, it's certainly not quite so tax friendly.
Yes, Tony. It's Tony, is it? It's not Keith.
That's right. It is.
Tony.
Yeah.
Yeah. Will the real Keith Curley please stand up?
Yeah, he's down there.
It's acknowledged that through the UK, it's very very encouraging to these share schemes. We always used to have to get it agreed via EU state aid to get these reliefs approved. And with that no longer being an issue, if anything, it might become even more generous. I know Ireland's not the easiest country to do share schemes in.
No, it's not.
It's not alone. You talk in the US, and you would think that they would have an equivalent, and they don't, or they do have an equivalent, but it's just nowhere near as efficient.
I spent 10 years working for Microsoft a while back, and that was quite a different option scheme to a startup one. But yes, it had its own quirks and issues as well. So.
But it's a good point that we are increasingly seeing schemes that want to be international. So this works great. PMI works great for your UK individuals. If you do have employees that are based in overseas jurisdictions, then you need to take your own local advice to see if there's anything, an EMI equivalent that you might be able to do for their jurisdiction.
Yeah, well, we certainly will at some stage in the near future, and there are a number of other reasons why it makes sense for us to have a UK office / subsidiary, whatever. So that will get into some of the other issues you were talking about in terms of the ownership of the UK operation, and whether it's eligible to do this kind of thing. But certainly something we'll be looking at very soon.
No, very, very interesting.
Well, it is 11 o'clock. And Grey Hair Works, we do things in 30 minutes. So thanks ever so much, David, for that. I think certainly what we realised, and hopefully some of you, when you're getting into this, it is very useful to have people on hand who can advise you on what you may or may not want to do. So after this, I'll send around the deck to you all, and I'll just connect David in on that. So if you've got any other questions, you've got his email address, and you can ping him over and take the conversation forward. And for Daniel and the real Keith, this has all been recorded, so we will share that with you too once it's been edited down. So thank you all very much.